Welcome to Volatility Trading Strategies, and this part 5 of the VB Threshold Strategy Replacement Series. So even for people not following my strategy, I think this is going to be an interesting video for you because I do discuss the issue of what do we invest in during periods of very low market volatility. It's actually a much more difficult market environment than most investors assume, and I'll get into why. Now, hopefully you have had a chance to watch a few of those other videos, but in case you haven't, I'll leave links here for 2 videos that you need to see in order to understand this very successful trading strategy. The first is explaining my volatility barometer. Now, this is an index that I've created that gathers data from all of my best volatility sources and combines it all into a single reading that is, in my opinion, the best measure of market volatility that you'll find anywhere. So please check that video out when you have a few minutes. It's only 10 minutes long and it is worth the watch. And the second video is actually going over the VB threshold strategy itself. You can see the results have been very consistent. And how this strategy works is, it uses those volatility barometer readings as a direct input variable to decide what ETFs I hold. So this is the volatility barometer on a 1-year chart. And the way the strategy works is, I divide this up into 5 equal 20% sections. And depending on where the markets are currently at, I know which asset class has the highest probability of success. And I hold only that ETF, and then wait for the volatility barometer value to move into a different section before changing positions. It's a tactical rotation strategy based on a very large data set of volatility metrics, and it's been very successful for me. So like I said, you do want to watch those 2 videos to get the full details behind it. But today's video is talking specifically about that 0 to 20% range of volatility barometer values. That's when market volatility is at its lowest, and when it is, my strategy is holding 20-year US Treasuries represented by the ticker TLT. Now, we do have some very knowledgeable investors in the VTS community who do occasionally like to tinker with the strategies and perhaps gear them more towards their own level of risk tolerance. One of the more common questions I get is, are there viable replacements for the TLT when the volatility barometer is in that lowest 20% range? So that's what I'm going to discuss today. Thanks for joining me. So let me start this off by showing you the baseline case for the ETF that I currently use, the TLT. And then after that, I'll show you some potential replacements and talk about why I don't personally use any of those. So this is showing the performance of TLT, only when the volatility barometer is in that 0 to 20% range of values. Now, it doesn't happen very often. This is the lowest volatility periods in the market. You can see that since inception, the barometer has only been below 20% on 8.64% of trading days, and a good chunk of those were in 2017. So for me, I really like this performance. Aside from one bad stretch, it's been very consistent, which is what I'm looking for. 13.32% return, with only a minus 6.27% maximum drawdown. So very worthwhile to hold TLT during this low volatility range. So if you have watched a few of those other videos, or even if you haven't, I'll just tell you now, one of the most common substitutes for treasuries is gold. TLT for treasuries and GLD for gold are fairly interchangeable when the volatility barometer values are in that higher range, 60% and above. That's when it's too risky to be holding stocks, and either treasuries or gold can work out pretty well. The question is, does the same apply here in the very lowest volatility range? Going just based on the results in the past 8 years, I would say no. The return here at just over 6% is half of what the TLT did, and the maximum drawdown of minus 12.5% is double what the TLT did. So based on that, I would say no, and for me it is a no. I use the TLT, of course. But there is a small case to be made here for anyone who really does like to find opportunities to hold gold. Even if you really like gold as an investment, I hope you understand why it's never a good idea to just buy and hold it. The price fluctuations are just too large to make that a viable strategy. But tactically trading gold, that's a different story, and there may actually be some potential here. You can see here the slide in performance was mostly from 2011 to 2015. And that's also when gold itself had a 45% drawdown from about $1,900 per ounce, down close to $1,000 per ounce. So that's why there's the negative performance there. It was a terrible stretch for gold. But if you're a person who believes that gold has stabilized, and perhaps even has some room to go higher here, then I would say holding GLD gold when the volatility barometer is below 20% is probably a good risk-reward trade going forward. Now, full disclosure, I'll still be using the TLT. That's what the VB threshold strategy is using. But a case could be made for GLD depending on your opinion and risk appetite for finding ways to get long gold. The next question I get a lot is, well, why not just hold stocks when market volatility is very calm? On the surface, that does sound like a period where the stock market should be performing pretty well, right? After all, that's probably why volatility is so low to begin with, because markets are calm. But actually, that's not the case. The S&P 500, the SPY here, actually returned negative 2%, with a minus 10% drawdown. So definitely not worth holding stocks when the barometer is below 20%. This just goes to show that when volatility is that low, to levels we don't see very often, that might be a sign that markets are stretched, maybe overbought a little bit, and we'd expect a small pullback, or at the very least some choppy action going forward. And that's why the SPY doesn't make much progress past that. And the ZIV here, which is a short volatility ETF, is just reinforcing that idea. Now it is positive, a 5% return, so that's a little better than stocks, but with the maximum drawdown of minus 16.21%, that makes it not viable during this low vol range. This is a common theme and something I'm always trying to educate investors on. It's not always obvious what we should do with those very low volatility periods. Some people want to stay aggressive and continue holding stocks or maybe short volatility. Other people want to do the opposite and play the contrarian, maybe short the market expecting some type of volatility spike that's just around the corner. I'll highlight a few of those in a second here, but for me, I've been doing this a very long time, and I've had the best results by just remaining conservative when volatility is in that lowest range. My tactical volatility strategy, for example, which doesn't use the volatility barometer, by the way. It has its own set of volatility metrics to guide decisions, but it actually outright holds cash during ambiguous periods. Since that incredibly low volatility period showed up in early 2017, the tactical volatility strategy has spent over 90% of the time in cash. Of course, in 2017, it was because of incredibly low volatility. And I showed trading is hit and miss during those periods anyway, so cash is the best risk management position. It's never fun sitting in cash, of course. Everyone wants to get in there and mix it up. But in certain market environments, it is the best choice. And then in 2018, because it was just a miserable year for volatility, this strategy was in cash for most of that year as well. We had the Volmageddon incident on February 5th, then one of the largest quarterly S&P 500 crashes in history at the end of the year. Being in cash just safely avoided all of it. And for a short volatility strategy, that's the exact point of them. To hit the markets hard and take out as much as possible during good periods, and then exit to safety and not lose any of those gains during bad periods. I feel that's how they should be traded. So while it is different than the VB threshold, the tactical volatility strategy also doesn't take short volatility positions when market volatility is in its lowest range. It's not a good risk-reward trade-off. But now let's check out some of those contrarian plays. Like I said, some people think that if stocks are stretched to the upside, then they may be about to crash. So this is the SH, a short S&P 500 ETF. You can see it's not terrible. As far as shorting the market during a bull market, doing so when the barometer is below 20% isn't that bad. Now, it's not successful, so I wouldn't consider this viable, but I'm showing it to highlight that it's actually better than holding long stocks through the SPY. People might find that interesting. Strategically shorting can be managed if done right. And getting a little bit more aggressive here, this is the VXY, which is a long volatility ETF. Now, this one tracks the further out months of the VIX futures, month 4 to month 7. So it does move slower and it is safer than some of the more aggressive front 2-month products. I'll show VXX in a second. But clearly the results are poor here, right? And the reason for that is simple. While it's true that the stock market may be topping at this point, and going long or short stocks as I showed was about a wash either way, the VIX futures term structure will still be in strong contango at this point in the cycle. And that's going to mean that long volatility ETPs like VXZ, and the others like VXX, UVXY, etc., they will still be decaying as the futures move towards the spot VIX at monthly expiration. And you can see it here even more clearly. This is the VXX, a front 2-month VIX futures product, and now the performance is really bad. Even though stocks may not be going any higher at this point, we still expect the long volatility ETPs to decay quite rapidly, and it's just a bad idea to hold them when waiting for a volatility spike. The implication here, and it is an important one, is that long volatility ETPs only go up after the market has already started dropping. It doesn't happen beforehand, so playing the contrarian by holding long volatility ETPs waiting for the next volatility spike is just a futile endeavor. You can lose far more money waiting for that to happen than you'll eventually make when it finally does happen. So be careful not to be that trader trying to time VIX spikes by using long volatility ETPs. The negative roll yield is just too much of a headwind, and it's not a good risk-reward trade. So here's a summary of all those potential replacements I covered. Again, we're talking about 8.64% of trading days, so not that common to see these readings. And to be honest, 10 years into one of the longest bull markets in history, it's certainly possible that we don't see volatility barometer readings below 20% again until after the next recession. But when they do come up, I hold the TLT. Solid return, very manageable drawdowns. To me, it's the safest choice by far. But for the reasons I outlined, for those among you who really do like to hold gold whenever possible, I do think outside of that very bad stretch from 2011 to 2015, gold should hold its own here as well. It's the only one on the list that I could endorse as a viable replacement. All the others don't have nearly the risk management in place that I demand from all of my trading strategies. For me, I'm all about risk management, smoothing out drawdowns, reducing stress, and making sure that I'm successful for many years to come. We certainly don't have to take excessive risk to make a really great rate of return. So if you are interested in adding this strategy to your portfolio, head on over to my website, claim your free trial, and see how I personally manage these crazy markets. See you next time. Thank you so much for watching the video. So don't forget to subscribe to the channel and go check out my website right here. There's tons of articles and videos on there, as well as a free trial to join the VTS investing community. What have you got to lose? Come see how I personally navigate these unruly markets. See you next time.